Bond investors have been feeling jittery for weeks, and as a result, government borrowing costs across much of the rich world have risen really quite high. A lot of what's happening comes from America, where the government has been borrowing an awful lot. $2 trillion over the past year, and that's before taking into account the budget bill passed by Congress earlier this month, which raises borrowing by even more. When the government is issuing this much debt, yields have to rise simply to match supply to demand. But they also rise because investors get worried that borrowing might become unsustainable. Another factor that's raising yields is policy uncertainty, also coming from America. No one really knows where tariffs are going to end up now. They seem to be announced one minute, rescinded the next, they're being challenged in the courts. And because no one knows where American trade policy will end up, they don't know what the hit to growth is going to be, what the hit to inflation is going to be. This uncertainty means that they demand higher returns, which are expressed as higher bond yields. There's a third factor too. A big buyer of long-term government bonds is the big pension funds. They use the guaranteed cash flows on those bonds to guarantee their future liabilities. But bond yields have been so high for so long now that many of these funds have bought all of the bonds that they need, and so they're fading out of the market, and a source of demand for bonds is therefore disappearing, which pushes yields up even more. For now, this is a market under stress, not a market in meltdown. But each time these jitters spread, the chances go up that prices will drop sharply, a big financial institution will come under strain, and perhaps financial stability will be threatened. So everyone needs to keep an eye on the bond market.